Hello everyone and welcome to another one of my investing videos where I try to simplify aspects of the markets and how they work. I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. In this video, I will try to explain the basics of a cash secured put and how it is used. If you're not familiar with options and the basic principles behind them, I suggest you watch my video on option basics. A cash secured put is a strategy used to generate extra income during times when the share price of a company is in an uptrend, sideways distribution, or accumulation phase. If used and executed properly, a cash secured put is a great way to augment your income. Cash secured puts are normally considered to be bullish. There are two key aspects to consider when writing cash secured put. For the first one, the seller must have cash or margin to cover the purchase of 100 shares. And for the second one, the seller must be willing to accept the possibility of assignment and the obligation to purchase 100 shares if the contract is in the money. When writing the cash secure put, you are essentially selling a contract stating that you are willing to buy 100 shares of the underlying at an agreed price if the share of the underlying reaches that price on or before the contract expires. If the share price is out of the money, essentially trading above the strike price, the buyer of the contract cannot exercise the contract and sell the shares to you. If the share price reaches the strike price, it is at the money and the buyer has the right to exercise their contract. The same is true if the share price is in the money and trading below the strike price. Let's explore several ways buyers and sellers can be affected when selling a cash secured put option. Suppose a company's share price is trading between $13 and $11 and a person decides to sell a cash secured put with a $10 strike price that expires in May and the price for the contract is $10. Now the stock will continue to be traded until expiration, but there are three possible outcomes that can occur at expiration. The possible outcomes are it expires in the money, at the money, or out the money. In scenario 1, the share price is at $9 at expiration. The buyer paid $10 for the contract and the seller collected $10 for selling the cash secure put. It is in the money. The buyer has two options. The buyer can sell the contract for its intrinsic value, or because the option is in the money, the buyer has the right to exercise the contract and sell 100 shares of the underlying stock at $10 per share to the seller, leaving the seller with a gain of $10 plus 100 shares. In scenario 2, the share price is at $10 at expiration. The buyer paid $10 for the contract and the seller collected $10 for selling the contract. It is at the money and the buyer can try to sell the contract, or because the option is technically in the money, the buyer has the right to exercise the contract and sell 100 shares of the underlying stock at $10 per share to the seller, leaving the seller with a gain of $10 plus 100 shares from this transaction. In scenario 3, the share price is at $11.50 at expiration. The buyer paid $10 for the contract and the seller collected $10 for selling the contract. It is out of the money. The buyer has a total loss of $10 and the seller will have made $10 from this transaction. A pro of a cash secure put is that it can help generate income. A con is that you are capped with regards to the profit you can make. For example, this is a profit loss chart for a cash secure put. If you sell a cash secured put with a strike price of $8 for $1, you will have a break-even price of $7. If at expiration the share price is trading above $8, the option expires worthless and you made $100. There is also a high loss potential. If it trades below $8, the contract is in the money and you could be assigned to purchase 100 shares at $8 per share. If it trades below $7, you could be assigned to purchase 100 shares and incur a loss in the difference between your break-even price and the current share price. Ideally, you want to sell cash secured puts during certain points in time. For example, after an extended move down with no news or catalyst, the share price of a company will usually pull back or go back up. After an earnings call, a company will give future guidance and you can get a good idea of the general direction of where the share price will go. Sometimes it will rally, other times it will flush. But waiting till after the earnings call, you can better position yourself so you don't get caught in the wrong end of the move. High implied volatility, or IV, can generate larger premiums. Here you can see AT&T on the left and Macy's on the right. They are both trading around the same price, but you can see that Macy's has a higher IV and as a result it has a higher premium for the first strike that's out of the money. IV rank and percentile are also important. Again, here we have AT&T on the left and Macy's on the right and their current IV rank and percentile. The higher the rank and percentile are, the better the odds of collecting a larger premium relative to its past performance. It's also important to keep in mind price action and other aspects of the market and not just trade based solely on IV. For example, here we can see AMD's share price failed to break past support multiple times. This could have been a good time to sell cash secure puts. Another time to sell could have been once the price broke above the resistance trend line and found support on the retouch. A large portion of traders believe that as a general rule, you can get a better balance of risk to reward by selling a put with a delta of 0.3 or less, and if it has about 35 to 45 days till expiration. Times to avoid selling cash secure put include right before earnings. Because as I mentioned earlier, earnings can cause the share price to go either up or down fast, and trying to collect premium before earnings can leave you in a position where you must purchase 100 shares for a significant loss. Open interest and volume are very important. They provide liquidity and relative ease when trying to close a position. I like to trade options with a minimum volume of 500 and open interest of 1,000. It's also important to know if you are opening or closing a contract. When you write a cash secure put, you are selling a contract and you are selling to open, giving you a credit. When you close a position, you are buying to close, resulting in a debit. Cash secure puts can also be used to enter a position at an ideal buying price. For example, if someone believes AT&T is fairly valued at $20 per share, they can keep selling the cash secure puts at $20 strike prices until the share price gets close to the $20 or it falls below and they get assigned from a cash secure put that they sold. If you found this information helpful and would like to see more videos like this or get notified when I release new videos, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see a video on a specific topic. Thank you for watching and have a great trading week.